Hello. It was a difficult year for stocks and bonds, but there are several silver linings. What will happen with rates and inflation? Will there be a recession or not? Or are we already in one? What are updated return and risk expectations for stocks and bonds? How is cryptocurrency similar to the Dutch tulip craze of the 1600s? That and more today in today's quarterly context webinar. Welcome to the quarterly context webinar of the advisory group for the fourth quarter of 2022 for clients and friends of the advisory group. I'm Greg Patterson, CEO, and the advisory group is a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realms, their fiduciary roles for employees through retirement plans, and their communities through foundations and endowments. To help in that effort, the strategic work we do with clients, quarterly context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, investor behavior patterns, and other information to help you stay more relaxed by staying informed. Where we curate the information out of the noise and to help you make better decisions towards your goals. We try to keep this to about 20 minutes, and we'll circulate later a video link should you like to view it again or pass it on to someone you think that we can help like we helped you. And if you have any questions, please submit them to the question box. So a number of topics we'll cover today that I mentioned just a moment ago. And we always like to start with a reminder of an idea that can help reduce tension and stress in challenging market and economic times. While it's not comfortable always to have challenging markets, it can help to focus on that space between the things that really do matter and the things that you can actually control. You can't control markets, you can control how you respond to markets and how you do planning to make sure and know how to stay on track during different types of markets. The news for the quarter involves some additional rate hikes in the fourth quarter. Turned out as the end of the year to be the worst stock year for stocks since 2008, the worst year for bonds essentially ever, going back to the beginning of the aggregate bond index inception in 1976. So, but some positive news in terms of returns for the quarter, despite the weak overall year. Rate increases, as mentioned, totaled 7 different increases, up 4.25%. The inflation forecast for 2022 is turned out to be about 6.5%, similar to the 2023 forecast for this next year. The overall stock market was down about 16%, with bonds not too far behind at a negative 13%, given the unusually large and rapid increases in rates. Those rate increases were an attempt to control inflation, to prevent inflation from doing more damage. And as mentioned in the prior quarterly context webinar, inflation has been higher than normal due to so much stimulus over the last 10 years. A lot of that stimulus was put in place to prevent depressions that might have otherwise occurred after the global financial crisis or the COVID crisis. After a period of time where growth stocks have really been in favor, have been significantly out of favor relative to value to the tune of over 20% in 2022. So patience is paying for those that remain diversified. And overall growth expectations for the U.S. economy remain relatively flat, with backward-looking revised numbers looking like they'll be close to 0%, with a reduced expectation of 1.5% growth in 2023. Overall markets, you can see nice to have no red in the current quarter and some very strong numbers above the long-term average annual returns just in one quarter. So that didn't fully offset by any means the year negative numbers you see there, which are still significantly down. But there have been markets, of course, that are a lot worse, with the exception of the bond markets, which have the worst returns ever in the bond market history, as mentioned before. Notably, U.S. market up about 7%. International stocks up more than twice that, given some cooling of the dollar after an extended period of dollar strength. So again, great example of how diversification can pay off over time. And even the bond market was up above the long-term average, and we'll talk more about that and expectations in a moment. It's also interesting to note that stocks and bonds rarely fall at the same time. It does happen occasionally, about 10% of the time, 38 quarters in 100 years. And it's only happened twice, including this last year, over a full 2-year period. So very uncommon, very unlikely to happen again anytime soon. But of course, there's no crystal ball. An update of this chart shows that despite that difficult year, long-term averages still remain strong. So when we're working on planning numbers for personal wealth or foundation endowment clients and developing saving and or spending policy strategies, it's helpful to know that things, despite the recent discomfort, are very much on track, with returns being still above projections and at or near projections and above long-term averages, depending on which segment of the market you're looking at. This histogram shows the annual returns going back to 1926. You can see 2021 was far above average, almost 29% return. Then some cooling here in 2022, down almost 20%, making it the 7th worst full year return in history. So not a great year, but still amazing that despite that, given the large rise on average in the 10 years prior, the 10-year return remains around 12%. So some of this cooling in 2022, aside from how it happened mechanically due to the rising rates and so forth, fits right in and built into this 10-year average. So still long-term numbers are strong. We've showed this before and may show it again, but if we look at the market returns and how it spiked up after the heavy dose of $5 trillion in stimulus in 2020, that may have been the primary driver of inflation and this boost in market returns shortly thereafter. And the cooling has essentially brought it back down to more normal levels. So again, a little bit uncomfortable, but still within the range. And we've been talking about for a number of years not to expect returns to remain that high. Things would normalize, revert to the mean. That's essentially what's happened. So really much more normal environment now, which is common over time. Don't want you to get too comfortable yet, because markets could still remain bumpy for a while. If we look at this greenish yellow-green line here, mustard line, it shows that it's a very roughly similar pattern to the cooling, the initial year cooling of the dot-com crash and the global financial crisis. The global financial crisis and the dot-com crash, however, had significant drops after that. That doesn't necessarily mean that will happen here. There could be some cooling as their nerves rise if it turns out the recession is called, even though, as we've mentioned before, and we'll mention again in a moment, usually when a recession is defined, we're already part way, and sometimes most of the way through it, and stocks have already bottomed and started their recovery. The other element that's important to remember here is the dot-com crash was a huge asset bubble, and the global financial crisis was a fundamental systemic financial system problem, whereas the current environment has really been driven more of a man or person-made effect, raising rates to try and control inflation. That implies also that there's now more dry powder for stimulus if needed in the future. So if the Fed sees this cooling in the economy, overcooling, could reverse rates and try to straighten things out a little bit. So that's some positive backstory there. So again, on the recession, most economists believe that we are in one or will be in one, and that's not surprising. Usually there's a couple of recessions every decade of some depth. Question is how deep, and there's still a chance that the Fed could thread that needle and have a relatively soft landing. What complicates that a little bit is, as we'll see in a moment, that inflation, while cooling, still remains higher than desired, and unemployment remains lower than the Fed would functionally like to see, because with higher unemployment that would normally be caused by higher rates, that cools the economy and spending, which cools the inflation. So it's a tricky tightrope for the Fed. The yield curve, which is the bond market's way of saying what it thinks about the future, is currently not a normal curve. As you can see here, a more normal curve looking on the 2021 curve. Currently, it's an inverted curve, which means that there are shorter term rates that are paying more bonds and have rates that are higher than longer term bonds. Usually that is a precursor to some level of recession. There have been periods in the last couple of years where there was an inversion that then flattened out again, straightened out. But just to be aware, that's essentially what the bond market is, and many economists, as mentioned a moment ago, are expecting some sort of recession. Inflation has cooled, although it remains high, and that's why the Fed has continued to raise rates, although the rates are rising at a lower rate change. That unemployment number, as mentioning, has leveled out, but still remains near long-term lows. And wage growth, however, has cooled a bit, which is a positive sign for inflation, even if it's not the preferred experience of consumers. Those rates we talked about worked their way down over several decades into near 0% rate during the stimulus period after the global financial crisis, and then here again after COVID, to try to prevent a much worse economic situation and depressions, and is now rising to more normal level. The bad news is, as we've talked about, that hurts bonds, challenging for stocks, but it leads to higher paying bonds in the future and more normalized rate, and better for those that have savings or short-term investments for near-term needs, whether it's a strategic short-term pool or even just the average consumer's savings account. The negative returns for bonds, you can see over time, it's very common to have negative returns, not very common to have such as big a drop as we've seen recently, the biggest drop since 1976, since this data was recorded. But you can see bond returns are starting on an upward trend, although it may be a little bit bumpy given that there may still be a few, although likely smaller, interest rates on the rises on the horizon. Whereas last quarter, the stock market valuations were a little bit below, this improvement in stock prices has caused stock markets on average to be right around the long-term average. So that means that prices are a lot more attractive than they were when they were considered overvalued for a few years. However, clearly not dramatically undervalued. So that may imply less of a huge bounce back and more of a gradual recovery for stocks over the next few years, with likely some bumps along the way as usual. Also, small cap stocks, which normally have higher valuations than large cap stocks, have been running at an undervaluation relative to large cap stocks, which suggests that there could be more of a return opportunity there, and hence a good reminder to keep diversification into such asset classes within a portfolio. Consumer sentiment hit a long-time low last quarter, has improved a little bit, but is hovering given the talk of inflation continuing, even if it's lowering, stock prices and bond prices being challenging, unemployment questions and so forth. But overall,
that's a positive sign. However, tricky for the Fed, because as consumers feel more confident, they tend to spend more, which pushes up prices. So the Fed actually doesn't want consumer sentiment to rise too fast, because that will complicate their battle against inflation. Volatility remains a little bit elevated, but not nearly at the level of the big events such as global financial crisis, .com crash, COVID, crunch, and so forth. And speaking of COVID, looking forward to when we can remove this slide as a relative non-issue, but it's has picked up in some areas of the world a little bit with the new variant. But the good news is that even if we're hovering at kind of a what might look like a relatively elevated level, global immunity has improved, which has reduced hospitalizations and deaths. And so you can see on this small chart here that the death rate has dropped off to a level that's closest to the last year or two and the beginning of the pandemic. So the less overall pain and suffering for families as well as the economy around the world. Some of you may have heard of the tulip mania of the 1600s in the Netherlands. For those of you that haven't, there's some interesting comparisons against the cryptocurrency environment currently, where many cryptocurrencies have dropped 70, 80, 90%. A wide array of cryptocurrency organizations have declared bankruptcy, when just a year ago or so, they seemed to be the high flyers that everybody was nervous about missing out on. So sometimes there are fads, and some people, although not too many clients, would sometimes ask us, well, why aren't you incorporating a dedicated component of cryptocurrency in your portfolios? And we say, well, we don't consider it an asset class. We believe there's more speculation than fundamental and intrinsic value in cryptocurrencies and currencies in general, and that there is significant risk in this unusual supply-based price boost, where there's kind of a craze where nobody wants to miss out, so it drives prices up, and eventually there should be some cooling. Well, that's exactly what happened, which is a lot like what happened with the tulip mania in the 1600s. Different, but in some ways similar, because of this sort of overexcited, don't want to miss it kind of behavior of buyers and investors. So the prices started skyrocketing in the mid-early 1600s there, and nobody wanted to miss out. Professional traders even got involved, and at the peak, the value of a tulip was the same price as that of a wealthy person's house or mansion, roughly about $750,000 in today's terms. And like the case with crypto and some other, the .com and some other cycles in the past, people thought prices couldn't go down, and it was an infinite paradigm change and shift, and they didn't want to miss out. And a bunch of people even borrowed money to buy, and that's when it really became a mess, when things collapsed and people didn't have, they sort of had to scramble to sell as quickly as they could to try to pay off their loans. A lot of fortunes were lost, and it dropped around 95% and didn't bounce back. So we're not saying that blockchain doesn't have any important, valuable implications for the future in lots of different technologies and industries, but currency specifically and some other ideas certainly can get a little too much attention if there isn't fundamental value that's being added over time. So this is a great reminder to differentiate between serious money and play money. If you get excited about something and you really feel like you want to put some money into it, consider doing that outside of the money you're counting on, money that you're willing to lose. And if you hit it big, great. But if you lose it all, it doesn't damage your plans and your strategy. Again, this applies to organizations and individuals. Let's talk now about the updated capital market expectations. We obtained this data from Callan. The advisor group is a client of Callan, and we leverage their econometric forecasting group's projections for risk and return across an array of asset classes to help us build our asset allocations and conduct spending policy analyses and other work for clients. And this data just literally was published yesterday. So the interesting and good news is that there's a more significant increase in expected return than there has been in a long time. The average increase for stocks is around 70 basis points or 0.7%, and for bonds hovering around 2.5 to 3% increase, which is an enormous shift in the capital markets projections because rates have gone up so much. So rates go up, bond pay higher yields over time. So painful to have current bond prices dip when the rates are going up, but new issues of bonds have a much higher rate. And so this has interesting implications for clients. For personal wealth clients, this may mean that some people can reduce their risk at the same level of return and accomplish their goals. Similarly, for institutional clients, for example, maybe that for a certain level of spending policy for an endowment, an organization can lower their stock mix or stock in the mix and increase bonds to have a similar outcome for a period of time. So something to consider and explore. Others may wish to maintain similar asset allocations if they're comfortable with the risk and achieve a little bit higher than previous return projections. So inflation remains similar, only going up by 0.25%, and cash also went up by about 1.5%. So that takes some of the sting out of the difference between inflation and cash of the last several years with such low rates and rising inflation. With the updated capital market expectations, we can also talk about what was expected, what type of asset allocation was expected to be needed to produce a 7% return over the last 30 years or so. So back in 1993, to get a 7% return, you could do it with only a small slice of stocks and 97% in bonds. 2008, about 15 years ago, about half and half, about roughly half stocks and half bonds. As bond rates and came down during all the stimulus years after the global financial crisis, bond returns and bond return expectations were low. So really, organizations really had to jack up their non-bond portion of their portfolio to get anywhere close to 7%. And now, 2023, with the increase in expected return, broadly speaking, but especially in bonds, we're back to about a third in bonds and the rest in non-bond asset classes to achieve 7%. So this is welcome news for many, and with only with less volatility, same expected return, which may help with planning and reduce some concerns about future returns. We have a live webinar regarding the Secure Act that was enacted in Washington at the end of last year. This webinar will focus more on the personal wealth implications. So take a peek at that. Join us for that. You'll learn something interesting in terms of the impact of the Secure Act on retirement plans on that side of the world. A number of interesting implications. Lawmakers are really trying to help address the undersaving of the population by increasing auto enrollment features. So new plans, as they get created, will be required to use auto enrollment. We encourage auto enrollment and auto escalation and have for a long time with all current plans as well. So something to explore at your end, but it will be a requirement moving forward for new plans. There are higher catch-up limits for those that are 50 plus, a new special higher catch-up contribution allowed for those that are age 60, 63, starting in 2025. There's an option for employees to treat employer matching and non-elective contributions as Roth, where that wasn't possible in the past. It could only be treated as a traditional contribution when it's coming from the employer. Other couple of the key notes, there will be a special hardship withdrawal that can be allowed from a plan up to $1,000 a year with no penalty. But in order to take another one out in the future, that has to be paid back within 3 years. Non-highly compensated employees can also save up to $2.5 thousand a year, or $2,500 to an emergency savings account. And so that's an interesting feature to help people more systematically save and reduce the chance that they will need to draw down more money from through loans from a plan if it allows loans, or hardships if it allows hardships. Another note, similar roughly in concept in terms of the government's trying to improve savings of the average person. California has a new law as of the middle end of last year that requires that small businesses with 5 employees or more offer some kind of retirement plan. If not, they have to provide access to the Cal Savers plan. And even employers with only 1 employee, non-owner employee, must make it possible to save in the Cal Savers plan if they don't already offer some kind of retirement savings plan. So that's good in general for people to stimulate savings, since there's certainly an undersaving across the country on average. A few new blog posts, how to recession-proof your portfolio, 10 questions that could change your life and financial independence, and more on recessions in your financial plan. So some interesting things there. If you're thinking or worry about recessions, there are a number of things that have already been set in place for clients to help prevent the impact of that relative to your long-term plan. So our blog, the articles on our blog are a good place to settle in and feel a little more comfortable with a lot of negative news, and it may lead you to some questions to talk to your advisor about. So we want to thank you for attending. We appreciate you joining today, and we always appreciate if having you as clients or friends of the advisor group, and if there are others you think we can help like we've helped you, please pass on the word. We'd be happy to talk with them, and you might be doing someone a big favor by helping them get on track, either personally or as for their endowment, or the participants when they're within their retirement plan.